Welcome to Breaking News to Trading Moves. We're looking at a specific headline today that has the retail world buzzing.
It does.
Kroger has appointed a new CEO, Greg Foran. And this isn't, a 6-month transition period. This change is effective immediately.
It's a very decisive move. And for anyone watching the grocery sector, the name Greg Foran definitely carries some weight.
Absolutely. So before we get into the winners and the losers, let's just lay out the ticker. For Kroger, that is KR.
KR.
Got it. Now, let's talk about the who here. Greg Foran isn't a new face to this industry at all.
Not at all. He previously ran Walmart U.S. and most recently he was leading Air New Zealand.
Which is a specific combination of experiences, isn't it?
It really is. You have the pure scale of Walmart U.S. operations. And that's combined with the logistics and, the service focus of an airline. But the market is really looking at that Walmart experience specifically.
And the market reaction seems to suggest they like what they see.
Well, they do. This is being viewed largely as an operations and turnaround hire. When you bring in someone with this kind of profile, the expectation isn't necessarily about inventing some brand new product. It's about sharper execution. It's about stronger digital operations.
It's about fixing the store experience.
Exactly. Getting the basics right.
And we have to place this in the current context.
Mm-hmm.
The U.S. grocery market is, it's not a friendly place right now.
Not at all. It is incredibly intense. You've got Walmart, you have Amazon, you have the discounters. All of them are putting immense pressure on pricing and on convenience.
So in that environment, you just can't afford to have sloppy operations.
You can't. The market logic here is that better execution is really the only way to defend and potentially gain market share.
So that's the headline. Kroger, ticker KRR, brings in a heavy hitter to sort of tighten the ship. Let's move into our first segment, the winners. Specifically, we're looking at grocery operators and this idea of execution upside.
Right. Execution upside. It's a phrase we should probably break down.
Yeah, what does that actually mean for an investor?
It means the value that can be unlocked simply by doing the basics better. A credible operator CEO, it signals to the market that there will be tighter store execution.
So the shelves will be stocked.
The shelves will be stocked, the pricing will be disciplined, and the back-of-house operations will just be more efficient.
So it's about removing waste and inefficiency.
Precisely. And if Kroger proves it can run cleaner operations and improve its digital fulfillment, the market often re-rates the entire grocery group. It changes the narrative from grocery is a low-margin struggle to operational discipline creates value.
So it kind of lifts the boat for others in that category.
It can, yeah. It signals that the traditional grocers aren't dead, they just need better management.
So obviously the first winning ticker here is Kroger, KR. But who else benefits from this kind of sentiment?
We should look at Albertsons. Their ticker is ACI.
ACI. Why them?
Because they're the closest peer, really, in terms of that traditional grocery model. If the market decides that traditional grocers can improve their margins through better execution, essentially, operational discipline over hype, then Albertsons often gets swept up in that positive sentiment.
It changes the investor feeling toward that whole group.
It validates the business model. That's the idea.
Okay, let's move to our second segment of winners, last mile and logistics. This seems tied to that digital operations point you brought up earlier.
It is directly connected. The reporting highlights that Kroger has been leaning into partnerships for delivery. They're rethinking how they handle automated fulfillment.
And Greg Foran's background would suggest he understands the need for speed and convenience.
Correct. So if Foran accelerates convenience, what we sometimes call the digital basket, it just means more volume.
Meaning more people ordering groceries online for pickup or for delivery.
Yes. And Kroger isn't going to go out and do all of that driving themselves. If they aggressively pursue this omnichannel execution, they generate order volume for the platforms that handle that last mile delivery. It increases merchant activity.
So who are the tickers to watch here then?
You have to look at the delivery giants. DoorDash, for one, ticker DASH.
DASH.
And Uber, ticker UBER.
UBER.
The logic here is pretty straightforward. A grocer that's aggressively trying to compete with Amazon and Walmart on convenience is going to need a fleet.
And these platforms provide that fleet.
They do. It's a symbiotic relationship in a way. Kroger gets the delivery capability without buying thousands of vans, and DoorDash and Uber, well, they get the volume.
Okay. Moving on to our third segment of winners, this one is a bit more behind the scenes. We're calling this retail tech and data enablers.
Right. This is what we would call a second-order beneficiary.
Explain that concept.
So the first order is the company itself. That's Kroger. The second order is the companies that Kroger pays to help them execute the turnaround.
Ah, I see. So you're following the money.
Exactly. Where does the money go?
Modern retail turnarounds are not just about arranging cans on a shelf. They require supply chain optimization. They require workforce productivity tools. They require better digital personalization so that when you open the app, it knows what you want to buy.
And all of that requires technology.
A lot of it. And execution-focused leadership, like Foran, they often unlock more tech spending. They know that to improve inventory, fulfillment, and customer retention, you need better systems.
You can't fix the operations with a clipboard and a pen anymore.
No, you need data.
So which companies stand to win from this kind of increased spending?
You look at the big consulting and tech infrastructure firms. Accenture is a key one, ticker ACN, and IBM, ticker IBM.
IBM.
These are the kinds of firms that provide the back-end systems and the consulting hours to restructure a supply chain. A grocery turnaround isn't just about food. It's about the data and the systems running in the background.
So a check written by Kroger could end up as revenue for Accenture or IBM. That's the logic, yes.
Okay, we've covered the winners. But in a competitive market, if someone is winning, someone else is probably losing. Let's talk about the losers, starting with segment 4, big box and mass retail.
This brings us right back to that competitive threat.
So who should be worried about a better run Kroger?
The biggest rivals. I mean, specifically Walmart and Target.
Let's get those tickers out. Walmart is WMT.
Right, and Target is TGT.
Why does a more competent Kroger hurt them? I mean, Walmart is enormous.
It is enormous, but grocery traffic is a battle for frequency. You go to the grocery store every week, right?
Yeah.
If Kroger improves its service levels, if the lines get shorter, the produce is fresher, the app works better, you might just stop splitting your trips.
You might just go to Kroger and skip that Walmart run.
Exactly. And to prevent that from happening, Walmart and Target have to defend their traffic.
And how do they do that?
Usually through what the industry calls promotional intensity.
That is the polite way of saying sales and discounts.
Yes. They have to drop prices. They have to spend more to keep customers from trying out the new Kroger. That puts pressure on margins for the whole category. Even the big players lose out if they have to sacrifice profit just to hold on to their market share.
The cost of defense.
That's it, exactly.
Now, let's look at another group of potential losers in segment 5, e-commerce and specialty grocers.
This is where the convenience part of Foran's history really comes into play.
So if Kroger gets better at digital, who suffers?
The digital-heavy rivals. So now we're talking about Amazon, ticker AMZN.
MZN.
And Costco, ticker COST.
COST.
The logic here is about customer acquisition costs, or CAC. A sharper Kroger just increases local competition in pickup and delivery. If Kroger becomes a viable, easy option for online grocery in your neighborhood, Amazon has to work harder and spend more to get your order.
It keeps pricing competitive across all the different channels.
It does. It removes the easy wins, so to speak, for the e-commerce giants.
What about the specialty grocers? You mentioned them as well.
Yeah, this is the value plus convenience threat. If Kroger can offer a decent organic selection, but combine it with better pricing and the convenience of pickup, some consumers might just trade down.
They stop going to the expensive specialty store.
Or they consolidate trips. Instead of going to a specialty store for the good stuff and then Kroger for the staples, they just do it all at Kroger because the experience has gotten better.
That really hurts the formats that rely on differentiation to command higher prices.
It creates a lot of pressure on them, for sure.
So who are the tickers here?
Sprouts Farmers Market is a prime example. Ticker SFM.
SFM.
And, of course, Whole Foods Market, which, as we know, brings us right back to Amazon, ticker AMZN.
So Foran's appointment isn't just some internal memo at Kroger. It sends a signal across the whole retail ecosystem.
It really does. It changes the calculus for everyone from the local specialty shop all the way to the boardroom at Walmart.
Let's wrap this up with segment 6, the simple trading lens. If you're looking at Kroger, ticker K, or what is the summary here?
The bull case for K is built on, I'd say, 3 things. Better execution, improved digital economics, and steadier guidance credibility.
Steadier guidance credibility. What do you mean by that?
Meaning, when they say they're going to hit a number, the market believes they have the operational control to actually do it.
Okay. And what should we be watching? If we want to know if this turnaround is actually working, What are the metrics?
You need to watch three things. First, promo intensity.
How much they're discounting.
Right.
Yeah.
If they have to slash prices to get people in the door, the gross margin suffers. You want to see traffic driven by better operations, not just by cheap prices.
Second,
Pickup and delivery profitability.
is the digital business actually making any money?
Exactly. It's easy to grow digital sales if you're losing money on every single order. It's much harder to do it profitably. That is the real test for Foran.
And the third,
Strategic changes to the fulfillment and automation footprint. You want to watch if they change how they're building warehouses or using robots. That'll tell you where the capital is going.
it's a lot to keep an eye on, but the strategy itself seems pretty clear.
The strategy is clear. The execution is always the hard part.
Before we sign off, I want to leave you with a final thought. We often look for these visionary CEOs who promise to reinvent the wheel. But in the current retail climate, with inflation and this fierce competition, there's something to be said about an operations hire.
It raises a question about automation specifically. A visionary might want robots everywhere just because it looks futuristic. An operations expert like Foran might look at that same technology and ask, does this actually save us money today?
Right.
It suggests we might see a change in how automation is deployed. Less about the wow factor and a lot more about the bottom line.
A focus on practical application over theoretical innovation.
Precisely.
That brings us to the end of this episode of Breaking News to Trading Moves.
And as always, a mandatory disclaimer. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.
Thanks for listening. We will catch you on the next one.